Okay, so we've had a choppy market over the past week, but our guest says we do have what looks like a dovish-leaning Fed, and we still got a lot of AI euphoria in the market. He reckons that stocks look poised to extend the bull market for yet another year. We're joined by Andrew Slimmon, Managing Director and Senior Portfolio Manager at Morgan Stanley Investment Management. Andrew, great to see you. Thank you very much indeed.
Hey, Andy, how are you?
Very good. So far, the U.S. economy ticking over. I know people say, well, look at the debt, the deficit, and corporate earnings holding in. So those two factors point to more gains for stocks, presumably.
Sure. Yeah, I mean, look, there's positive, negative. The positives are, the speed with which the Fed cuts under the new Fed chairman, is to question, but they are in a cutting regime. We are going to get tax cuts here. Coming starting this month. That is, that's positive. Mm-hmm. Earnings are coming through. That's certainly positives as well. And, the consumer is kind of morose. And actually, when consumer is morose, the rate of change can improve. And that's a positive sign. The negatives, though, Andy, is the market's up a lot. And naturally, there are a lot more optimists about the market today than there was 2 years ago when the opportunities were better. And this is an important point, when you have high expectations of GDP growth and high expectations of earnings growth, the stock market tends not to do as well as when there is low expectations. And that's a quadrant we find ourselves in. So I think it'll be an okay year. But, we're getting later cycle and there's more dangers out there.
Give us that again. When there's high expectations of earnings growth, the market
and high expectations of GDP growth, it's the lowest returning quadrant for the stock market.
Why is that? Because obviously people have done their perhaps investors have already done their buying.
Exactly, Andy. So when expectations are high, that's a danger sign because the misses or when they come in weaker or lower. It's no different than the consumer, though. It's got low expectations. So if actually you get tax relief, the consumer might surprise on the upside.
Reminds me a bit of quantum physics. The observer is entangled irrevocably with the actual phenomenon, but we better not get bogged down on that.
But Andy, that's the consistency of investing in stocks is investor behavior. That's the only thing that's consistent is how investors react. If you wind the clock back to October 2022, we had a 25% decline. What a great time to buy stocks. People didn't buy in 2023, they sold. The conflict of investing is stocks care about what's going to happen in the future, but we all look in the past to frame our viewpoints. So, right now, the past looks pretty good. So people are pretty optimistic, but stocks are high. In 2023, the past was bad. Stocks were low, but the past was bad. So people were more pessimistic.
So we have an S&P, let's say it's at 7,000 right now. It's very close to that. Where do you guys roughly see it ending the year?
Well, I think earnings will surprise on the upside. But I don't think you're going to get any multiple expansion. And so, I think you could see a 10% return this year. It's not going to be as good as the last, 3 years. That's again, the consistency of later cycle when investors get more optimistic, return scenarios come down.
When you say later cycle, you can always debate whether the market moves in cycles or not. Maybe we could put up a 20-year chart for the S&P 500.
Sure.
But what kind of a cycle are you talking about here? Are we nearing the end of the U.S. economic rally? Is there going to inevitably be a slowdown, for example?
All I'm saying is, Andy, normally you get the bull market cycle lasts, not always, but somewhere around 5 to 7 years, and then you get a bear market, and bear market's a 20% or more correction. We came close last year, but not quite. So late cycle, what happens is investors get more optimistic, and so something comes along and the economy turns down, and it causes a substantial correction. I don't think it will be this year, but I am concerned with all this liquidity coming, with the Fed cutting rates, with tax relief coming, could this be inflationary down the road? And then could the Fed have to pivot? And if you look at, the last 11 bear markets, most of them, over half of them are caused by higher inflation, the Fed having to pivot and raise rates. So I think that's the biggest risk out there. I'm not sure it's this year, but ultimately that's what causes the end of cycles. And you have a bear market and then you start over again. And we'll start over and I'll be on at some point, Andy, going, the market's down 20%. It's time to buy. And people, oh no, there's a lot of things to worry about.
The midterm, the elections coming up, always lots of heat and noise, sound and fury. What generally happens to the stock market in a midterm election year?
Yeah, I mean, it doesn't mean the market goes down, but it means it's not as good a year and you get more volatility. Now, the reason for that is very simple. The sitting president, doesn't matter, Republican, Democrat, wants to have their party win the midterm. So they roll out a lot of populist kind of policies to win votes. And that unnerves the stock market, unnerves investors. And you get, pullbacks. And look what's happened this year. We're already talking about capping credit card rates and a little bit more vocal against the big banks. I mean, these are very populist kind of moves. And, that's normally what you see in the second year.
Andrew, thank you very much. Always great hearing from you.
All the best, Andy.
Andrew Slimmon, Managing Director and Senior Portfolio Manager at Morgan Stanley Investment Management.